In this, the 36th lesson in the course, A Critical History of Economic Theory and Policy, we examine the record of the administration of George W. Bush during his presidency of the United States. As William Jefferson Clinton was poised to leave the presidency, the illusion of prosperity continued to exist across the nation. Yet Clinton's vice president and the Democratic Party's candidate to succeed him were not able to convince the nation's voters he and the Democrats deserved to remain in office. On the campaign trail in July of 2000, George W. Bush announced, among other things, his economic plan. He stated, "And I happen to know that one of the reasons we have this surplus is that the taxes on the people who are working hard are the highest they have been since World War II. There is a difference of opinion in this campaign." There is a big difference of opinion. My opponent thinks the surplus is the government's money. We know the surplus is the people's money, and we're going to share some of that surplus. What George Bush meant by sharing the surplus eventually became clear. Tax relief for all Americans exacerbated an already accelerating concentration of income and personal wealth at the expense of balancing the government's budget. In February of 2003, the New York Times printed a statement signed by 450 economists opposing the Bush tax cuts. This read as follows. Economic growth, though positive, has not been sufficient to generate jobs and prevent unemployment from rising. In fact, there are now more than 2 million fewer private sector jobs than at the start of the current recession. Overcapacity, corporate scandals, and uncertainty have and will continue to weigh down the economy. The tax cut plan proposed by President Bush is not the answer to these problems. Passing these tax cuts will worsen the long-term budget outlook, adding to the nation's projected chronic deficits. This fiscal deterioration will reduce the capacity of the government to finance Social Security and Medicare benefits, as well as investments in schools, health, infrastructure, and basic research. Moreover, the proposed tax cuts will generate further inequalities in after-tax income. Whether the Bush team believed their own rhetoric or not, they sought and got tax reductions for those with the highest incomes, for corporations, and for speculative activities by investors. Reducing taxes at almost any cost, and at the expense of funding for what most people accepted as essential social programs and the nation's infrastructure, seemed to drive the Bush team. The Republicans, with some Democratic support, cut individual income tax rates, reduced the tax rate on capital gains and on inheritances. The marriage penalty was also removed from the tax system. The nation and the economics community held their collective breath. But as tax revenue came in, it was clear that those at the top were the primary beneficiaries, even as the nation's debt skyrocketed. Conservative analysts later pointed to what they viewed as significant improvements in the economy as evidence that tax cuts were working, despite clear evidence of which taxpayers benefited most. Looking at the data compiled by analysts at the Heritage Foundation, one could conclude that the reductions in high marginal tax rates on individual incomes, on gains on the sale of assets, so-called capital gains, and on business profits were having a positive impact on the U.S. economy. With such statistics, however, there is always more than one possible interpretation. Joseph Stiglitz, who served as Clinton's chairman of the Council of Economic Advisors, reflected in 2007 on the changes in direction orchestrated under George Bush. The Clinton years were not an economic nirvana. I'm all too aware of mistakes and lost opportunities. The global trade agreements we pushed through were often unfair to developing countries. We should have invested more in infrastructure, tightened regulation of the securities markets, and taken additional steps to promote energy conservation. We fell short because of politics and lack of money, and also, frankly, because special interests sometimes shape the agenda more than they should have. But these boom years were the first time since Jimmy Carter that the deficit was under control, and they were the first time since the 1970s that incomes at the bottom grew faster than those at the top, a benchmark worth celebrating. While I have considerable respect for Joseph Stiglitz, who served as an economist at the World Bank and has been a vocal critic of the bank's lending policies in developing countries, I have to conclude that even he did not then, and perhaps still does not, appreciate the crucial role of property markets and tax policies in our economic system. Tax cuts in 2001 did not result in revenue growth. Remarkably, after 2003 and additional tax cuts, additional revenue began to come in. The question is, from where? Total federal revenues grew by about $625 billion, or 35%, between fiscal years 2003 and 2006. Revenues from corporate income taxes rose from 1.2% of GDP in 2003, their lowest level since 1983, to 2.7% in 2006, their highest level since 1978. And yet, this analysis by the Congressional Budget Office concluded that almost half of the budget deficits occurring under Bush resulted from tax cuts. What was going on? Average individual incomes of the top 1% of taxpayers increased from $295,000 in 2003 to $388,000 in 2006. The top 1% of taxpayers in 2006 received 22.1% of the nation's taxable income. Those who defended the tax cuts noted the fact that the top 1% paid 39.9% of all federal income taxes, or about the same amount as the bottom 95%. What they ignored is the skyrocketing increase in disposable income experienced by the top 1%. Households at the top gained an average of over $54 million between 2002 and 2006. By mid-2003, economists were describing the results of the Bush economic program as a jobless recovery. Official unemployment, which averaged 5.8% in 2002, hit 6.1%. Over 3 million more persons became unemployed. Private sector payrolls were down by 260,000 workers for a total job loss of 3.1 million since the recession began in March of 2001. Real median earnings fell for the last 4 quarters in a row. The loss of employment was the largest percentage decline in any post-World War II recession. Early in 2004, President Bush took time to explain to his countrymen what was happening with the economy. He stated, "Recession means that people's incomes at the employer level are going down, basically, relative to costs. People are getting laid off." Military expenditures escalated far above the projected supply-side increased revenue effects of reduced taxation. Note that the red line tracking trade deficits shows record increases with only a slight leveling between 2000 and 2001. Moreover, job growth occurred primarily in healthcare and other services. The U.S. lost 3 million manufacturing jobs between 2000 and 2005. Job growth in the service sector was lower paying and with few benefits. The soaring cost of imported oil, combined with all other imports, resulted in record trade deficits climbing to $618 billion in 2004, then to $718 billion in 2005, and $817 billion in 2006. The end result was to put U.S. dollars in the hands of trading partners who chose not to use a good portion of these dollars to purchase goods and services from U.S. producers. Rather, billions of dollars were loaned back to the U.S. government or used to purchase U.S. businesses and properties. By 2007, the U.S. national debt hit $9 trillion with no signs of leveling off. Pressed to protect profit margins and share prices, U.S. companies moved more and more jobs to other countries. Economist Paul Craig Roberts, who served as Assistant Secretary of the Treasury under Ronald Reagan, noted in 2004, Americans are buying the same goods as in the past, made by the same U.S. multinational corporations. Only the goods are no longer made in the United States. Their production has been outsourced or offshored to Asia. The same goods now count as imports because they are produced offshore. A country cannot close its trade deficit if its economy is being moved offshore. What also must be acknowledged is how disproportionately unemployment affected young African American men. Many had never finished high school. A high percentage of these young men were or had been incarcerated. Fred Harrison makes this rather insightful observation about the attitude of Americans toward the long-standing and worsening concentration of income and wealth in the United States. An economic class structure divides the people, and yet they unite in celebrating the laws that segregate them. The facts are laid out in the official statistics, and yet no one interprets them in terms that can lead to calls for a renewal of the campaign for civil liberties. The political conflict between those who describe themselves as conservatives and those who advocate liberal or progressive policy blinds them to the true meaning of privilege under the system of law and taxation. A change in whichever party holds a majority vote in state legislatures or the federal Congress makes little difference in the range of policies pursued or the level of influence by special interests. As this long course has shown, within the economics discipline, there are only a few professors among past generations or those active today who recognize that nature, land, is a factor of production with very distinct characteristics from those of labor and capital goods. This remains the great flaw in mainstream economic theory. Neither economists as a group nor the people who serve the public in elected office give thought to the most fundamental issue societies face, namely, what is the moral basis for private property? Libertarians, for example, say they are against all forms of coercion, yet as a group, they are blind to the injustice attached to monopolistic control over nature. One measure the Bush economic team might have explored was to reform how public lands were awarded to private entities for exploitation of natural resources. Competitive bidding could yield market rents for timber resources, the rents consistent by whatever environmental protections and other restrictions are imposed on the timber companies. The same analysis applies to rents coming from the leasing of mineral lands, grazing land, land leased for wind or solar farms, gas and oil fields on dry land or offshore, even the harvesting of fish from publicly held lakes or rivers. Instead, the Bush administration did its best to simply remove from protection public lands set aside during the 3 prior presidential eras. The equally serious issue of obtaining for the public the full rental value of any lands leased to private interest was never considered. The Bush administration also proposed selling more than 300,000 acres of forest land as well as other public land. This approach to quickly raising cash rather than leasing public lands to yield market-determined rents is politically attractive, but sacrifices the long-run public interest, particularly when the annual taxes imposed are far lower than the full annual rental value of the land involved. Rising land prices, as always, made their way through the United States economy and contributed to the continuous movement of production facilities and jobs to other countries where profit margins were much higher. Low wages commanded by the labor force is one main reason for such moves. Another is the low or almost zero cost of compliance with government regulations and environmental protections. In 2004, the Chinese began a serious effort to restore their environment and shift away from coal as a primary source of electrical energy. This graph shows the dramatic increase in spending by the Chinese on clean energy. By 2009, the Chinese were spending double that of the United States, nearly $35 billion.